Hey there, investors. My name is Sean Corbett. I do marketing for Boardwalk Wealth. And today we're going to chat with Omar about some ways to wrap up 2019 and also what he's seeing on the horizon for 2020. So, hey, Omar, how's it going?
Hey, I'm good, Sean. How are you?
Pretty good. Just winding down the year, like I said. Well, let's get into it. So I was hoping to ask you about a particular trend or trends within multifamily that were hot, but you sort of see fizzling out and not really worth any attention in 2020.
See, I think one of the trends that I do see, well, I don't know if it's fizzling out, but what I do see amping up, and then I feel like by the middle of the year, or say maybe when we're maybe a quarter into the year, people will start waking up on is that not every multifamily deal is a value add deal. Value add has become it's such like a buzzword, right? Like AI, automation, machine learning, that people slap that and everybody gets horny because every deal is not a value add deal. Because, for instance, it's the same as every deal is not a stabilized deal. There are different deals that fall into different buckets. So, and I think what a lot of people are doing is stretching the definition of this. And that might actually become very dangerous because in the past few years, the market was going up. So you could do everything stupid and somehow still things work out when you're exiting because the price has gone up. So all of your operational mistakes get washed away. But going forward, I feel this would be something where a lot of people who are doing this stuff will start, at least the investor side, will start seeing that, hey, just because somebody says there's interior renovations, doesn't mean there's interior renovations. I mean, think about it this way. In Dallas, for instance, there are properties that have gone through like 4 versions of new sponsors coming in and doing interior renovations and taking it to the next level in the past, say, 6 years. And you're thinking, well, how many levels are there? I mean, eventually, either you become a class A ultra luxury property, which none of these properties are, or you're not, in which means there is some sort of a ceiling, right? And everybody can't be coming in and taking it to the next level, right? Because what was the last guy doing? Was he chopped liver? Was he dumb? So those are some of the things that I think hopefully should fizzle out as investors become a little bit more attuned, I would like to think. But I don't think the sponsor is going to stop doing that. It's got to be more investors who try to put the brakes on these things.
So would you consider a deal that you absolutely know is not value add, or is that your filter point?
Well, I would consider a deal. I wouldn't call it a value add deal, right? That could be more of a stabilized deal. So let's put it this way. That's in a very good location. You're getting it at a very fair price, which could be market, which is okay. It's in a very good market. And the bulk of the work is done. A little bit of work needs to be done all the time. But it's a good long-term play. But again, the deal here is you're not getting these weird returns. What you're really getting is slow, steady, safe return year in and year out, right? So that's an example of a stabilized deal. I would totally consider that. But that's a different bucket. You can't call that a value add deal. It doesn't really work like that.
And then
by the way, it has been working like that, but realistically it shouldn't, and it won't.
Yeah, so they're going to stretch the definition of value add until value add A doesn't mean anything, and then B, it's going to start to make people skeptical as soon as they see that word.
Yeah, and just remember that it's never the sponsors that are going to stop doing this, right? So it's never the people who are trying to get your money who are going to stop doing this. I do feel like with more investor education, the investors will have to start pushing back, and I think they will start pushing back.
Yeah. Okay, that's good. Well, so then that kind of takes me to my next question, which what are the main 2 or 3 submarkets you're going to stay focused on in the new year, and why?
So one of our big pushes is basically in the Southeast. So Atlanta specifically, in and around Atlanta. In and around Jacksonville, Orlando as well. I know that's more like 2 submarkets, but I consider it one area. It's just because we want to expand more in Jacksonville. It's just that it's not a big enough market for us to get scale as quickly as we liked. So Jacksonville, Orlando try to do that, Atlanta specifically. And we're also actually putting the feelers out there for markets like Charlotte and Nashville. But again, Charlotte has a lot of stock, so there's a lot of trades that can happen there, and one can potentially get scale. But again, it's a very competitive market. But Nashville is one of those interesting places where in the past few years, it's really boomed. It's on the right trajectory. Lots of good things happening, lots of tech jobs moving, and lots of knowledge-based workers moving, lots of really interesting things happening. But because it wasn't booming, say, from the mid-90s or say early 90s onwards, so what you have is a big lull in construction, right? So you have like, say, a 7-8 year construction lull where some properties did get built, enough didn't get built. So you have, say, some 80s product, barely any 90s products, and then you have all this product from the 2000s plus coming online. So it's a structural issue in terms of how much supply you can get in that market. And the other deal is that I think that market is slowly evolving and maturing. But what's happening is, they say, unlike mature markets like Atlanta or Dallas or Houston even, where it's a big enough market, so there's lots of product there, but also there's lots of players there who trade in and out of their portfolios, right? So just because of the size and scale of what they are and sophistication of what they have, they trade in and out of their portfolio. So there's lots of volume of trades happening in a market. In Nashville, that volume isn't really there. There's a couple of regional players that own a good portion of the market. They barely have now started trading and churning through their portfolio. And hopefully that improves over a period of time, because what happens is if you got 3 players or 4 players that control something like 40% of the market and they never trade their properties, well, what happens is just the amount of volume of trading that can happen in the market is highly reduced. So then it makes it very hard for somebody who's not from that market, or even who's from that market but not from those particular groups, to get scale. And this business is all about eventually getting to scale in a market or in the number of units. That's why, for instance, you don't see us doing less than 100 units, because the cost structure is just not compelling enough for do it. And what happens is, when you do, say, a couple of properties at 150, 200 units, 300 units, and then you layer them on, you have like 3-4 of these in one market, you then really start seeing economies of scale on the cost side, economies of scale on the revenue side. You can really drive down costs. And look, if you drive down costs, then basically what happens is, then that goes directly to the bottom line, i.e. investors make more money.
Yeah, and that's what you're trying to build in those 3 submarkets that you just talked about. Yeah. And how are you feeling about Texas right now?
Oh, I love Texas. So Texas is one of those markets I unfortunately didn't mention. The problem in Texas is everybody else loves Texas as well. So the problem there is, I would love to do a deal in Texas. We've done a few deals in Texas. We're actively looking for deals in Texas, but it's coming to the issue where there's a few issues. So the prices are just insane, even compared to other areas of the country, relative to, the rents and all of that stuff. But the other issue also is that a lot of the jurisdictions, especially in Texas, like Tarrant County in Dallas, the DFW area, Harris County in the Houston area, they are really ramping up the pace and intensity of, and the growth basically in taxes. So they're really going, so taxes are doubling in some cases year on year. And the biggest cost on your P&L from an expense point of view is taxes. Everything comes after taxes. So if your taxes are increasing at an exponential rate, the problem is a lot of these deals aren't even penciling out. But on the flip side, what's happening is that a lot of out-of-state buyers, a lot of newbie buyers are coming into Texas, so they don't realize these things are happening, and they will base their pro forma and projections on, say, the tax rate growing at, say, 2% a year, right? Assessed at, say, 85% of value. And the problem is, in these counties, the taxes will be assessed at 100% of value, and they might be growing at 5% a year. So your pro forma gets blown. So when you actually take over the property, your numbers are so far behind, because this is your biggest line item, that you get slaughtered. And then if a local person wants to buy your property, they'll know all of these things. They won't pay the price that you supposedly got this property at. And then the person who owns this property is out of state or doesn't know this stuff, is now basically left holding really overpriced property and hoping the price of the value increases enough for them to justify paying for that price. But again, that's more speculation rather than anything else.
Okay. Yeah. And speaking about taxes, actually, we get some questions from potential investors about 1031 exchanges into a syndication. Mm-hmm. I know this is something that you'll do, and a lot of other sponsors won't accept. So I was hoping you could talk a little bit about the motivation for both stances.
Well, look, the motivation for us is very simple. We aim to serve our investors' needs, so we're at their beck and call. And at the end of the day, if somebody has a 1031 and we know them, we have a relationship with them, we'll help facilitate that into one of our deals, no problem. Now, the caveat there is just that, you got to have a couple of $100,000, at least like $150,000 to $200,000, because it's no use for us to go through all this pain, loss of brain cells, and all this aggravation, say for $30,000 of gain, right? So keep that in mind. Now, why don't some people do it? I understand why some people don't do it. It involves more complexity, more legal work, more administrative costs. A lot of times it holds up the closing. And by the way, that happens more than you would think. So I understand why people don't do it. And it's just, to be honest with you, it's such a pain in the ass to do. But again, we do it with the people that we have a good relationship with, but they need to have at least a couple of $100,000 at the bare minimum, right? And the other deal also is we need to know them personally, because there's a lot of paperwork involved in this. And a lot of times what happens is when you're in the middle of the deal, you're trying to close that deal. And if one person, because they have a CPA who's never dealt with real estate before, right? But he's never going to say he's never dealt with real estate before. He puts his foot down because he wants to do the best thing for his client. And you're like, dude, you're a dumbass. You've never done this before. Why don't you talk to you tell the CPA, why don't you go consult with the CPA who deals with real estate transactions? And a lot of those guys, obviously when you call somebody a dumbass, they get all defensive. So obviously, right? I mean, somebody calls me a dumbass, I'll get offended, right? So, but they kind of hold up a lot of these things. Lawyers are the exact same things. You might have somebody's brother-in-law who's a divorce attorney who's now advising this guy on commercial real estate transactions. I mean, it's like, if you want to get a kidney replaced, you don't go to a pediatrician, right?
Yeah.
It's that sort of a deal. So a lot of things happen which can hold up the deal. And you don't want, like, say, a $25, $30 million deal being held up for $150,000. Right? Because you're like, dude, I could just pay it out of pocket and close the deal. So
yeah, and then that guy's holding the whole deal hostage.
Yeah, so
everybody else. Yeah,
exactly. So basically, we need to have a relationship with the person. But then it's not. I mean, we have a system down. We have lawyers. We have all of that stuff. We've done it before. So it's not the end of the world. But I can understand why a lot of sponsors don't want to do it. I completely understand why they don't want to do it.
Okay, got it. Now, sometimes investors come to us to ask about other deals they've been offered. And usually when they ask, at least to me, it means something's off in their gut. So what are a few of the things that you see out there that make you cringe, basically some recurring red flags for crappy deals?
Well, so look, the number one thing I think is trust, right? Because what I tell people is, look, the two main things that I test, because I invest my own money into other people's deals, right? But the two main things that I basically test for, and again, it's kind of hard to test for these things. So, you kind of want to have multiple reference points, is basically the person's character, right? Again, which is very nebulous because no crook is ever going to tell you they're a crook, and their competence, because it's no use having somebody who's really honest, who's really nice, but a complete idiot, right? And similarly, it's no use having the world's most intelligent person, but they're a crook. Right? Because both things are done. And I think the confusion a lot of people have is a lot of people, even, which is kind of weird to me when people say this also is, and by the way, they say it to me, so I'm not saying I'm not in this deal. You sound like an honest guy, right? And a lot of times my response to that, because I just want to be upfront with people, is, look, of course I sound like an honest guy. Do you think somebody's going to go on a podcast and radio and tell you they're a crook and they're going to run away with your money to Mexico? What else is somebody going to do? Of course, they're going to sound like a nice guy. So my point is that shouldn't be where you stop. Like how somebody sounds, well, anybody can sound like anything. In fact, the most dishonest people sound like the most honest people, right? But then testing for competence. So as an example, I ask people, look, it's pretty easy. You do your initial screening and all that. And then you ask very specific questions about previous deals. As an example, look, a lot of this deal is highly dependent on the pace and velocity of your rehab units. Like how quickly are you rehabbing them? It's really project management and blocking and tackling. So when you ask somebody, you ask them, okay, so kind of walk me through your construction management process and specifically, so because you're looking for specifics. So tell me, what are some of the things you've learned in the past quarter or past few deals, What are some of the things you've learned, some of the things you were good at, some of the things you're bad at? Now, a lot of times what happens is people give really wishy-washy answers. Oh, we've got a great property management team that handles all of this. You're like, great. How many units did you rehab last quarter? How was that against budget? Why were you behind or why are you ahead, right? And then kind of show it to me like, I'm sure you have some sort of a project management tool, you have some sort of Excel spreadsheet or Google Sheets or whatever spreadsheet in the cloud. How do you manage all of this stuff? And I can assure you, most sponsors, they can't even answer that question straight. The reason why they can't answer this question straight is because there's one thing to buy a property. In fact, it's one thing to buy any business. Look, if you pay enough money, you can buy anything in the world. But it's a completely different ballgame to execute on the business plan, right? So as soon as when you ask specific questions, and anyone, by the way, gives you a really wishy-washy answer, right? The first time they can be excused, right? Because maybe they didn't understand your question. But you got to press again. And if they're not able to give you a specific question, as an example, last quarter, I mean, I don't remember. This is what I tell people is, okay, hold on, let me open up my file, right? And it's all on the cloud. And in fact, all people have their files on the cloud. So it's pretty easy to see this. I'm like, okay, hold on, give me one sec. I'll open the file. I'll see, okay, yeah. So for our property in Jacksonville, last quarter, we did 21 units. The reason why we had this, like say the 1 bedrooms, we only did say the lowest level of renovation, but the 3 bedrooms, we did the highest level of renovation is because on the 1 bedrooms, we're at or near market. So there's no use for us to go spend more money. But on the 3 bedrooms, we realized when we tested it out that there's a big demand for this for a certain type of clientele, typically their families. And they are willing to pay an extra 100, 200 grand because they got kids, they got lots of things going on, right? They just want a turnkey solution, right? So, but again, that's some level of specificity, right? And if somebody is not able to give you specificity, run the hell away. Literally run the hell away. Because at the end of the day, this is not a business that part-timers, it's like any other business in the world. You can't be a part-timer and do this, and you might get away, or rather you might get away with it for a couple of months, but like all bad habits, will come to bite you in the ass. And the problem is, when bad habits come to bite sponsors in the ass, the problem is it's the investor's money that is lost, not the sponsor's money. So
yeah, you're talking about the multifamily version of the absentee landlord.
Yeah, exactly. And the problem is, for the lack of a better word, if shit hits the fan, it's not the sponsor who's basically a lot of times has their own money. In fact, most of these sponsors don't even have a dollar in the deal. It's typically the investor's money that's at stake. So it's a case of heads I win, tails you lose. So heads I win, if everything works, I look like a genius, you think I look like a genius, and you give me a lot of money. But if things don't work, well, I guess I lost all your money, bad luck, shit happens, whatever, right? So ask more specific questions. In fact, you can even go to our blog on Boardwalk Wealth. There's actually literally, in fact, let me pull it up. There is literally a blog called The Inside Track to Wedding a Multifamily Deal Sponsor. Literally. I know it sounds boring as hell for a lot of people who don't like reading. So they say they want to read an audiobook, which they don't even understand how that happens. But literally, you can read it, okay? If you're that bored, pay somebody to read it to you. But it sure as hell beats losing your 50, 100 grand. There's another blog post literally called Deal Screening Checklist for Passive Multifamily Investors. In fact, don't even use your brain. Go read that. If you don't want to read, you can't read some version of that, have your girlfriend or wife read it to you, right? Because my assumption is if you got $50,000 or $100,000 to invest, you have the capability of reading, mostly, 9 times out of 10. So go read. Read it for 5-10 minutes and save yourself the hassle.
Oh, sounds good. On the subject of tenant demand, I have a sort of convoluted question, so hopefully you'll bear with me here. Basically, I was hoping you could talk about how you view and then serve tenant demand, both from the side of when you're looking for a property to put together a deal, and then also the years of management after the deal closes. So specifically, when we're talking about the operation stage, like you just mentioned, right? The 1 bedrooms versus the 3 bedrooms, what are the families in the area looking for? I know you're relying on your property manager to a certain degree.
No, not just my property manager, right? We're also relying on third-party data. We do rent comp surveys. So that kind of there's lots of points through which we have to try and triangulate a decision.
Yeah, so as a sponsor, how much direct contact with the tenants do you want? And how do you decide what really moves the needle versus what's just an inconsequential request?
Okay, so I have 0 direct contact with the residents or tenants. 0. It's not my job to be somebody's mom. It's not my job to get to be friendly with people. My job is to the investors. I have to be a fiduciary of their money. So frankly, I already have a lot on my plate. I'm not going to go personally talk to the investor, to the tenants, but what we do have are tenant satisfaction surveys. What we have is our teams on the ground that actually go don't talk to tenants. They kind of note all those things down. We collect all of that data. But me personally, I'm not doing any of that stuff. Now, with all this data, like tenant quality surveys, tenant satisfaction surveys, online reviews, blah, 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 blah. Again, that does help us find an answer. But at the end of the day, you've got to realize a lot of people want to go off their gut, especially a lot of these old timers. They want to go off their gut, which I honestly don't even understand why you would do that. But at the end of the day, numbers don't lie. Cash flow doesn't lie. Profit and losses don't lie. and data doesn't lie. So somebody can complain all they like about the fact that they don't like the paint scheme in their apartment, but if that apartment is $50 below market, they're not moving anytime soon. Okay? So you've got to realize, even with online reviews, we militantly manage that, right? But you've got to realize, a lot of times what happens is all the pissed off tenants, and by the way, in any business, not just ours, in any business on the planet, all the pissed off people go online and bitch and moan. And the vast majority of happy, satisfied tenants, what they do is, because they've got a life, they've got a job and kids and family and all that stuff, and they actually are sane. A lot of times you have 100 happy people and maybe only 2 people will go online and say, oh, good job, I really appreciate it, right? So you kind of almost have to be knowing how these things work. But again, we collect lots and lots of data, but am I going to go personally and, I don't know, say hello to a tenant? Sure, if I'm visiting a property, I will, but that's just being a nice person.
So in one of the properties in 2019, you had discovered that a lot of the tenants, for small upgrades, right? One of the things they wanted was USB plugs, which makes sense to me. But if I was renting, I wouldn't look for that. But then when you said it, I thought, yeah, okay, that makes sense because we have a little plug converter.
Yeah, but see, you've got to realize it doesn't make sense to you right now. But but now pretty much that everything is being charged with USB ports, right? Pretty much everything is being charged with USB ports.
For sure, yeah.
It's
so
one of those things. Yeah, go ahead.
How did you discover that? Like, how did you guys get that idea? Was that the property manager telling you that those requests were coming in, or how did you happen upon that little thing?
I'm going to be honest with you.
Yeah.
I have so many devices that need to be charged, and I'm so sick and tired of looking for a USB port that I decided to just put it in. And I was like, I bet you, I swear to God, I am not the only one in America with, say, devices that get charged through the USB port, right?
And did you get immediate feedback?
Yeah. Because the feedback is very interesting. The feedback is, and it was really weird because I was like, and first of all, they don't even cost that much, so it's not like you're spending a lot of money. Because every time, you put like a plug which has 2 plugs, like one of those, whatever those things are called, panels that have 2 plugs in it, you can have 1 plug and 1 USB port. Or like one of those double USB ports, right? Where they're either arranged vertically or horizontally, so they take the same amount of space, but you have 2 USB ports now. So I did that just because I was like, okay, everybody's got a smartphone or some device. But it was really funny. We tested it out, and the immediate response from a lot of tenants wasn't necessarily, oh my God, this is great. They were like, wow, this is really thoughtful. I didn't even realize I needed this, but as soon as I saw it, I realized how much I needed it.
Totally. Yeah.
Right? So it was one of those things. But you know what's really funny? Who really does see these things? It's really funny. What we figured out is women really see these things. It's the same as a lot of times we have guys touring properties. They're looking for an apartment and they, do typically what I would do, right? Just go into an apartment. Hey, everything look fine? Compare it. Everything looks fine. Is the price right? Is the manager okay? Is the apartment building fine? But what was really funny is a lot of our female tenants, when they're looking for this, or especially, when a couple shows up, a lot of the female tenants directly go to the bathroom and they turn the taps on or the shower on because what they really want to see is the pressure of the water. And I can tell you this, having lived in places where the pressure of the water was not enough, right? So it's really drippy. Oh my God, it just annoys you so much when you can't get a good hot shower at a high pressure. But that was such a good thing for them to test. And I started incorporating that into other areas, like really test the pressure of the water. But those are, again, small little things that you don't necessarily realize you need. But if you get it, or if you've never had it before and you get it, you're just like, the mood of the whole room just lifts. It just calms itself down. You're relaxed. Everything is fine. And you're okay with paying an extra $50.
Yep, that makes sense. And so that's something that you're looking for in a property management team too, then that level of attention to detail, I would assume.
Yeah. Because you've got to realize small details make a big difference, right? And it's all about, and it's like any business, right? It's all about customer or tenant satisfaction. So the more easy we can make it for somebody coming in, right? Because think about it this way. If somebody comes in and their response is, wow, I didn't even realize I needed that USB there, but it makes so much sense that we have USB there. You have a USB there. What's really funny is they'll forget all the other things in the apartment and they will remember that one thing. So when they're comparing, say, against 2 properties that are kind of the similar-ish properties, right? But they'll be like, oh yeah, but that one has a USB port. And you're like, yeah, you could go to Amazon, order like one of those USB converters for $5, right? And then both apartments are kind of the same, and all you did is spend $5. But people don't make that leap. They're like, oh, it's already there. It's so nice and comfortable. I don't have to think about it. So that's the thing they remember.
Yeah, it's indicative that someone is actually thinking about you and taking care of you. Yeah,
it's an indirect thing, but what happens is then that you could be slightly off on pricing. Your paint might not be as nice. Some things could be, a little bit of a difference here and there. But the one thing they did remember was the paint or the the pressure of the water, the USB, and that really sways basically their decision one way or the other.
And just like you were talking earlier about vetting deal sponsors and how you have a list of questions you advise people to ask, I assume that you have the same list of questions when you're vetting a property manager to put onto a new deal.
Oh, yeah. So we have the same list of questions. A lot of this is basically for us, a lot of this at the scale at which we're working. A lot of the questions are around, well, how good is your bench strength? How good is your accounting and finance team? How many CPAs do you have? How many properties do you manage in that area? Show us basically an org structure, all the sort of organizational level stuff.
Got it. Okay. Now, changing gears here for a sec, I remember coming into 2019, and we talked a lot about it, and a lot of sponsors were putting out content related to predicting a market correction. And then we kept talking about it, and then all of a sudden we stopped talking about it.
Yeah, because when you're wrong, you eventually have to shut up, right?
Yeah. So as we now approach 2020, do you double down and say, well, it has to happen sooner or later? Or do you forget about it? And how is this affecting how you're operating and how you're looking for deals? And what's your outlook on all that for the next couple of years?
Well, look, the fact is that I wish I knew when a market correction was going to happen, because I'd be so rich, we wouldn't be having this conversation. But I don't know, right? I don't know. And I am humble enough to realize and say, if I don't know something, I don't know it. And that's just the way things are. What's really funny to me is basically all these guys who barely graduated college or high school suddenly become like an expert on the Fed's monetary policy. It's really funny. Everybody's suddenly an expert on quantitative easing and the Fed's monetary policy and the rate and volatility of interest rate changes. Everybody's suddenly a derivatives trader, and they still make less than $100,000 a year. And you're like, no shit, dude. If you're so freaking smart, why are you broke? Right? Why are you on LinkedIn, man? Because most of the traders I know, most of the investment bankers I know, they don't got time to be on LinkedIn and bitch about stuff and do social interaction and posts. So obviously, your broke ass doesn't know anything, or it knows the same as I know, which is basically not a lot, right? So basically, shut up, take a step back, and always be conservative when you're looking at deals, right? So for instance, what are we looking at? Is the thing cash flowing, right? Then how much margin of safety do we have? For instance, we stress test when we buy, hey, if things go off the rails for say a year, what happens then? And the biggest thing that it's really funny, because I'm an immigrant, so at least I guess I can say this, and I've observed this, is that most Americans are obsessed with the end of times. Guys, I say this to my investors all the time. We don't live in Zimbabwe. We live in the US of A, okay? This is the greatest country on the planet. It's the greatest economy humanity has ever known. And it's not going to collapse overnight. Shit doesn't work like that. It's not a third world country, okay? The US has the great 2008 financial crisis, lasted a year and a half. In most countries, that's not even considered a recession. That's considered business as usual. And all of America had a meltdown. So what I'm trying to say is we live in America. Things the world isn't going to end tomorrow. You should continue doing what you supposedly should be doing, is being conservative, stress testing your portfolio, always being militant and paranoid about your operations, and just never taking your foot off the gas pedal, right? So in operations, you got to go, get your units rehab, manage your P&L, manage your people. Doesn't matter if it's a recession or boom time. When you're buying, you got to keep touring properties, keep talking to people, keep underwriting, keep stress testing. And again, we're not trying to do like 300 deals a year. We're really trying to do 4 or 5 a year. So the bulk of your work has to be saying no. In fact, if you're saying yes to everything or the vast majority of things, this means there is something really wrong with your screening criteria. And you need to go evaluate that first, as opposed to pontificating on the Fed, what the Fed is going to do, or where the macroeconomic policy of the world is going, or if there's a conspiracy theory between all the central banks in the world. Chill out. Go have a beer, relax. If you don't have a friend, get a dog. That might help.
I can buy into that. So I know we talked basically entirely about multifamily on this call, but also you have mentioned over the last year or so that you've looked into a couple of different types of investments. I wondered if you were comfortable sharing some of that with us and what you're sort of looking into now, what you'd like to offer, say in the next coming months, if obviously, like you say, if the deal makes sense, if something comes up and it doesn't matter what trends are, it has to pass your filters.
Yeah. So for instance, in our particular case, I'm looking at one or two particular startups within Texas. They're dealing more with mineral rights, and it's a very interesting space. It's a very big market, and the reason why it's a big market is, and why nobody's been able to tap into that market is because there's an information arbitrage. And what I mean there is that there's a lot of information about mineral rights, but that's just in silos everywhere. So the Texas Railroad Commission might have something, and then ExxonMobil has their own database, and this person has their own database, and that person has their own database. But what happens is, anytime you want to go get clear information about mineral rights or similar rights of land rights and all of that stuff, man, assembling this information is a pain. Right? So similar information arbitrage businesses, I'm actually looking at from a data consolidation and startup point of view on the technology side. On basically the operational businesses side, it's doggy daycares. Now, a lot of people laugh. Doggy daycares, really? Yeah, you'd be surprised. This industry is growing at 40 to 50% year on year for the past 5 years, and it's expected to grow at the same or higher pace in the coming years. A couple of reasons include the fact that people are having less kids. A lot of millennials and the generation above them, they have a lot of disposable income, especially the ones in the urban areas. And when they don't have kids, they spend a lot of their money on animals. Okay, it's just weird how much money is being spent on animals. And it's a very high margin business. Like what I laughed is the first time I found out that doggy daycares charge anywhere between $50 to $100 for a dog's, check this out, manicuring a dog's nails. And I had to laugh at that. I was like, first of all, well, the dog isn't really going to say if they had a bad manicure, right? So you could really get away with providing really shitty service, which you shouldn't, but you could if you think about it, right? Because what the hell is the dog going to say? Sharon, my nails weren't done properly. You shouldn't pay this guy $50. No, they're not going to say that. So it's a very high margin business. Then the other businesses that I looked at are car washes. Then personally, because now I have a kid, my kid started going into the daycare. And when I dropped my kid off, I actually started doing the math, how many kids there are in his class versus what the cost outlay and all of this is. And then luckily or coincidentally for me, I knew a really good family friends of ours that run a daycare out in New Jersey, and the cash margins there are like 35, 40%. This is cash margins, right? Now, again, it's an operationally intensive business. You need to know the right people. You need to partner with the right people. But the big thing in all of these businesses that I mentioned is the fact that they are still kind of run by mom and pops, right? Because industry consolidation hasn't necessarily happened in the way you would think it is, right? For instance, when you think of fund management, there's like Vanguard, BlackRock, Fidelity, right? And they own something like 60%. Or when you think of hotels, you think Hilton, Wyndham, and a whole bunch of these other hotels, that there are a couple of brands that own like 60, 70% of the market. But in these markets, because they haven't consolidated that much, there's a lot of arbitrage there. Either because, say, the operators right now might be really good operators, but they don't know how to scale, or they don't know how to raise money. Or if they know how to raise money, they don't know how to operate the business. So there's lots of small little nuances which you can then basically use selectively to basically enter into a market with high barriers to entry, but good margins, but then scale within that market very quickly.
Vehicle for the same type of investor that we're serving with multifamily now, or are there varying levels of risk? Are you looking for more or less money? Are the time horizons different?
Oh, yeah. So all of those things. So yeah, number one, what I'd like to say is, yeah, these different investments, different types of businesses, they're not all made equal, right? In the sense that they're not suitable for the same type of investor or the same type of person. So as an example, somebody is looking for, say, let's just put it this way, a startup might be higher on the risk side of things than, say, a stabilized business like a multifamily stabilized business, or say a stabilized car wash. So you have to really segment people out, and you really have to explain to them the risk perimeters, the return perimeters, the time period, whether there will be a liquidity event or not, all of that stuff. So yeah, there's a lot of stuff going on. But what's really funny is when I talk to investors, they all seem to think they fall into all of the buckets. It's really, it's an interesting thing, because as soon as you explain to them, they're like, look, It's your call. Look, obviously it's your money. I can't tell you what to do with your money, but based on our conversations, I want to be honest and upfront with you. I don't really think this is a good deal for you because it doesn't fit your criteria, right? And it's what's really funny is a lot of folks are like, no, it fits my criteria. So there should be a lot of segmentation. And by the way, sponsors should do it, but I'm going to be honest with you, sponsors are not going to do it. They just want your money. They're not going to do it. So investors themselves have to really take a step back and understand, even though some numbers might really appear really high, it might be a really good deal, but you've got to realize that some businesses might not be a good fit for an investor where they are right now or where they want to go. And that's just the way it is. It's okay to say no. I do that all the time. It's good to say no, but just realize there's a lot of segmentation that happens.
And we'll absolutely do that too. When we are ready to roll out these deals, we'll be as explicit as possible at the start of the deal and every communication that we give as to what ideal type of investor might fit for that deal, right? We're always going to put that information front and center. Like you said, it's up to them obviously to decide, but yes, we're segmenting on our end as well.
Yeah, I agree with you. And one should segment because look, at the end of the day, there's lots of fantastic people. There's lots of fantastic businesses in the world. But look, as an example, the opportunities that say a Bill Gates or a Jeff Bezos, for instance, would find compelling I was going to say might, but they will differ from the opportunities that I find compelling. And that's just the way it is. That's just the way of life. So, why not segment is what I think about it.
Yeah, and I think if you're extremely excited to get your distributions every couple of months with a multifamily deal, and that's one of your favorite things, you may not want to jump in on the startup deal.
Yeah, I agree with you.
That's a different mindset. It's a totally different mindset.
And the holding period is also very long, right? Because it could be a home run or it could be a complete dud, right? The risk is just really skewed.
All right, awesome. Well, Omar, I appreciate your time today. I don't know if you want to wrap up, if you want to say anything to the investors before we sign off here.
I'm going to be honest with you. All sponsors, including myself, by the way, well, all the marketing always sounds great. Okay, trees grow to the sky. You'll make money, more money than you know what to do with. And we all know that's not reality. So it always pays to take a step back. And the deal of the century comes by every 2 weeks. So if you missed one deal, who cares? Relax. It's better than losing all your money.
Yeah, for sure. No, well, as always, thanks for listening. Thanks for taking the time with us. And we're looking forward to another great year, 2020.
Yep. Thank you so much.